Hello, and welcome to Portfolio Matters Weekly Update, Week 44. But before we get into it, Richard will read the disclaimer.
Thanks, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Okay, Keith, what do we have this week?
Well, we have another very busy and eventful week, both in the stock markets, bond markets, and in commodity markets. The coal price had an astonishing week. Okay, so news this week. Well, the Fed has announced it will begin tapering from November. Now, it's not raising rates, it's just slowly reducing the amount of money it's pumping into an already inflating economy. And the Bank of England, having foreshadowed the fact it was going to start raising interest rates, then didn't. Okay, so moving on to this week's economic data, and it was a busy week. So we had EU inflation numbers, and they came out hot. So EU inflation was up 4.1% in October, and that massively beat expectations. Expectations were 3.6%, and so it's 4.1% in October, up from 3.4% in September. Core inflation also ticked up to 2.1%. The manufacturing PMIs were fairly reassuring, 58.3, slightly down from September and slightly down from consensus, but resilient in the face of supply chain issues and rising energy prices. In the US, we had PCE inflation, that is personal consumption inflation, which is the Fed's favored measure, and that rose to 4.4% in September, up from 4.2%. And it was on consensus. The core was flat, 3.6%. Now, we also had loads of manufacturing PMIs. So in the US, the manufacturing PMI for October was 60.8, which is a very strong number, slightly down on September, but ahead of consensus. The new orders, however, showed significant slowing, down to 59.8 from 66.7 in September, and well below expectation, but that is still a strong number. However, the manufacturing prices index showed a big leap, up to 85.7 from 81.2 in September, and well above expectations. So manufacturers are raising their prices. Now, in the UK, we had manufacturing PMIs, and the October number was good, 57.8, which is up from September and slightly ahead of expectations. The services, however, was good. It was 59.1, well up on September and well ahead of expectations. And in the UK, the vast majority of business is in the services sector, so that leap in the service sector PMI is very reassuring for the UK economy. And as a result, the composite PMI rose to 57.8, up from 54.9 in September. Now, in China, the manufacturing PMI for October was 50.6, which was reassuring, slightly up from September and slightly ahead of consensus expectations. Services also rose slightly, up to 53.8 from 53.4 in September and above expectations. And as a result, the composite rose marginally, 51.5 in October, up from 51.4 September. We also had some quarterly data. So in the EU, quarterly GDP growth for Q2 was 2.2%, which is very reassuring. That's quarter on quarter. Year on year growth in Q3 was 3.7%. Now, bear in mind, there are comparator issues for year on year data. And in the US, the employment cost index was 1.3% in Q3, up from Q2 and well above consensus expectations. But the really important piece of data this month, although this week on Portfolio Matters, is US unit labor costs, preliminary figures, Q3, quarter on quarter, 8.3%. Quarter on quarter, 8.3%, massively above Q2 and massively ahead of expectations. And we will go through now the inflation data, and all the central banks were essentially saying that there's going to be this wave of inflation which will pass, and it's all transitory, and hence the Bank of England doesn't have to raise interest rates. Well, if people start seeing that inflation's rising and demanding wage rises, then their comfortable narrative collapses. And what you're seeing from that number is a wage price spiral starting, or actually well developed. New policy. We've got loads of stuff to get through. And what we're going to do is flick through these charts really quickly. If you're interested in any one of them, then pause the video and have a look. But instead of spending 10 seconds a chart, we're aiming to do them in 2 or 3. Okay, so this is EU inflation still on the rise. UK manufacturing PMIs ticked up a tiny bit. UK services PMIs ticked up more strongly. As a result, the composite was up slightly. In the US, the ISM manufacturing PMIs were down a touch, but still pretty good. New orders, though, are coming down. And remember John Dizard's point about if supply chain issues stop being a problem, then a load of inventory suddenly comes out of the supply chain. And at that point, you cut new orders because you've got all your inventory that's sitting on a trailer somewhere. Your manufacturing prices rising in the US, and in the EU, manufacturing PMIs have stopped falling. Reassuring. Chinese manufacturing PMIs picking up again, and services stable. As a result, the Chinese PMIs are flattish above 50. Now, US initial jobless claims continue to decline. That's great. And continuing with jobless claims are on a steady downward trend. So it looks like the US economy is doing absolutely fine. Thank you very much. Okay, on to inflation. So we had EU inflation numbers for October, and they were not reassuring. As we've just covered, the CPI rose to 4.1% in October from 3.4% in September. Now, the Fed have been buying $80 billion a month of treasuries. Now, that is just the treasuries. Bear in mind, they are also buying a load of mortgage-backed securities, and they will start tapering both from November. But their purchases of treasuries alone, they will start tapering by 10 billion a month, and they'll start tapering MBS by 5 billion a month. But bottom line, they're still pumping money into the economy, even when inflation's running hot. Okay, so going through some charts on inflation.
So soaring breakfast prices. Obviously, there's the McDonald's price of McDonald's hamburger or beef burger, isn't there, as one of the indicators. This indicator showing basically that food prices, breakfast prices, have gone up by 70% or so in the last year and a bit, and but that's hugely significant. And in the US, month-on-month inflation is falling. Year-on-year, it's rising. Well, but what we're really seeing, if you look at the food price inflation per the breakfast chart, is that there is steady inflationary pressure on food, at least on food. And I think viewers by now know my personal view on the inflation data that's produced by the official statisticians around the world. labour prices going more expensive. I mean, we have a sort of contradiction, don't we, in that labour force participation in the US is dropping, has dropped significantly from pre-COVID. The tightness in the labour market, which is being shown by the reduction in the unemployment rates, but a lot of people have removed from the market, and that is putting pressure on US labour. And this graph, this chart shows that the quit rate is climbing steadily, steeply up from post-COVID lows, and that US wages and salaries follows it, and the quit rate is high, and they're not showing any signs, particularly, of slowing down yet.
Yeah. So what Nordea is saying is that if the historic relationship between the two holds, then wage inflation is only going to get worse over the coming months.
Consumer inflation expectations are rising, obviously in the light of what they're currently experiencing. And the long-term inflation expectations remain anchored, and I'm not quite sure how they measure this, frankly. And it seems to be, if I think inflation is rising now, I'm probably going to think long-term inflation is going to be a bit of an issue too. But this is saying people aren't particularly concerned about long-term inflation.
Well, the thing is, Richard, the headline, which is from John Authors in Bloomberg, I disagree with, because, you know, the Fed has got a 2% inflation target, and long-term US consumers are expecting inflation of what now, 2.75 and rising.
Yeah. The other thing is that we've got this strike by the workers at the John Deere agricultural machinery factory, where they've turned down something like a 10% pay rise now, plus cost of living increases over the next 2 or 3 years. I mean, it strikes me as being quite a generous package, and they've turned it down. That indicates that the labour market is getting quite sort of antsy in terms of managing its pay expectations. And clearly, that feeds into annual inflation. So there's a bit of a contradiction there, perhaps.
No, that's interesting.
So US fertilizer costs have almost quadrupled since the start of 2020. A significant part of this is the price of natural gas, which is the raw material that goes into production of fertilizer. And that will in turn feed through to increasing food prices, because A, it costs more to make the food, and B, to grow the food, and B, farmers may well use less fertilizer, particularly on marginal crops, and therefore the production of the crop will be lower.
Well, these are steel prices, and you will be aware that China has mandated that all their steel mills substantially reduce output in the second half to conserve electricity. And as a predictable result, the steel prices have risen sharply. It's actually in the US they seem to have risen the most. And that, of course, will feed through to inflation in all sorts of manufactured goods, including
clean energy systems such as wind power and solar panel arrays.
Yep. But we're seeing commodity price inflation absolutely everywhere. So this is cotton. And so cotton prices from their lows in 2020 have more than doubled. And so, you know, price of your jeans is about to go up. And this is wheat. And as a result of all this, businesses are increasingly concerned about inflation. And we know that they're planning to raise prices and are already doing so. Now, one of the reasons we are seeing inflation is because of supply chain disruption. And this is the freight rate index, and Maersk came out this week with a statement saying they expected supply chain disruption to last well into 2022. And so freight rates have tripled in the past year. But this is a chart actually from today, and you see that the recent fall in shipping rates from China appears to be gathering steam. So is this the beginning of the end of the supply chain disruption? I mean, let's hope so.
If I just chip in there, because I think it's we're at a slight watershed, I suspect, because lot of the inflation has, we don't know how much, but some of the inflation has certainly been caused by supply destruction, either because it's not being produced in factories or it's stuck in the supply chain. And of course, raising interest rates doesn't necessarily impact that source of inflation, because interest rates reduces consumer demand, but it doesn't encourage increasing production. So if you've got supply destruction, you don't want to raise interest rates. That may be one of the reasons why the central bank's quite hesitant about raising interest rates, because they're not really clear what the cause of the inflation is. And they know that one of the raising interest rates, whilst it addresses demand, doesn't address supply problem.
Absolutely. Well, this is actually one of the reasons that the Bank of England gave for not raising interest rates, was that inflation is in itself a dampener of demand. And so they were expecting a reduction in UK GDP growth, in part because of rising costs. But I mean, that narrative wholly depends on consumers and businesses not being able to achieve above average wage growth or pricing growth for businesses.
The consumers and the business simply absorb the additional prices rather than going out to try and address their own income levels. Which
exactly
isn't how an economy actually works.
And also, taking that their narrative at face value, Richard, why should they ever have to raise interest rates?
Indeed.
Because the inflation will suck out demand, so you don't need to do anything about it. I mean, what's the point of central banks?
Exactly. Well, that's a good question, Keith. That's perhaps for another edition. What is the point of central banks? So Europe has shifted rapidly from excess supply to significant shortage. So this is a measure of euro area supply constraint. And in fact, it is at an all-time high and double its previous high, which suggests there is a lot of tightness in the supply chain and a lot of cost pressure, therefore. And the UK supply gauge is showing something very similar, actually. In fact, even more marked, possibly, that there's a great deal of supply shortage and the cost pressure coming through there too. There is really very little that is indicating inflationary pressures are receding, apart from the possibility that container ships are getting slightly cheaper.
This chart actually is from Bloomberg, so it's not from Twitter. And what it shows is Bloomberg's model of the expected path of inflation given supply constraints, which we are seeing. And if supply constraints persist, as the chairman of Maersk is saying, then you can expect inflation to stay higher for longer. Okay, moving on to bond yields. And it was a volatile week in bonds. So the UK Bank of England, having essentially pre-warned the market that, that they were concerned about inflation, and the market was then expecting them to start raising rates, at their meeting this week, then decided to not raise rates, despite raising their inflation forecasts yet again. They do this absolutely every month. So the blue line shows actual, the pink line shows their expected path for inflation back in May. That was their May forecast. The blue one is August. The green one is now. And each time inflation gets higher and more persistent. And yet again, they've done absolutely nothing about it. Yeah. And the reason that they gave for not raising rates was they expected supply chain bottlenecks and inflation to do their job for them, basically, so that the growth would come down.
It does make one wonder what on earth their inflation forecasts are based on, because they clearly don't work, and they clearly don't change the way they try and calculate it, and it doesn't work again. So, and I think it must be very difficult to forecast inflation, actually, because there are so many variables in the economy. You work out which one is dominant at any particular time.
Yeah.
So it's, but surely, if your forecasting system is broken as it is, You need to say it's broken, and we are going to try and fix it.
But I think it's a very difficult job, Richard, honestly. So, however, when the Bank of England failed to raise interest rates, bond yields fell. Bond yields fell across the whole of the near end of the curve, and they hardly rose at the long end. So what that's telling me is that the Bank of England retains the confidence of the bond market.
Can you just explain this chart, Keith? I don't quite get it.
On the x-axis, you have time, and the pink line is interest rates, the bond yield over that period, as of prior to the Bank of England announcement, and the blue line is post. And you'll see that over the course of the next 2 years, the expected bond yields fell. The 2-year fell, but
it fell by about 25%. Looking at the right-hand edge of the graph, which is a big fall.
Now, what that means is the market is being set by expectations for Bank of England base rate rises rather than for inflation. And at some stage, if the Bank of England loses control of the narrative and the bond market expects inflation to be persistent at, say, 5%, then they're not going to want to buy UK government bonds yielding 1% when over 2 years they will lose 10% from inflation. At that point, bond yields start to rise whatever the Bank of England does. Now, on that note, we go to Australia. Well, that's exactly what happened. The Royal Bank of Australia had attempted to keep 3-year yields below 0.1%. But in response to steadily rising bond yields, they essentially would either have to buy unlimited numbers of 3-year bonds in order to drive down the bond yield to below their target. And that meant pumping a load of money into the economy. And they didn't do that. What they did instead was abandon the target. They accepted that they couldn't defend the rate.
This is interesting, because one of the views is that the Fed will always control the yield curve. But what this is saying is that the Bank of Australia couldn't control the yield curve. And the other thing is that governments do have the ability to mandate, for example, that pension funds must purchase a certain percentage of their assets as government debt. And that, of course, is one way that they can increase demand for government debt when the interest rate on the debt is too low.
Yeah.
And that, of course, is effectively a taxation on savers. And if you run your own pension scheme, then you don't suffer from that. But if your pension scheme is run by an institution, then that is entirely feasible.
What this chart shows is, if you look at the x-axis, that is the bond duration. And if you look at the 3-year, so the Royal Bank of Australia was trying to keep the 3-year below 0.1%. And 30 days ago, they were already failing. But then when they gave up, the bond yield leapt, 3-year bond yield leapt above 1%. So these are quite big moves.
They are.
Now, last week, when we had the ECB meeting, Christine Lagarde signaled that the pandemic emergency purchase program, which they've been using to buy loads of EU government bonds, would end in March 2023. And so you had a dramatic rise in Italian bond yields over last week, which is reversed this week.
Presumably because the ECB bought their debt.
Well, yes. Presumably, you're probably right, Richard. This is the Greek, which again sharply spiked and came down. And this is Spain. Now, Spain seems to have left the pigs. So Spain no longer seems to have bond yields which were a cause for concern. It's just Italy and Greece, actually. Now, markets are increasingly expecting central banks to have to raise interest rates. So this, the blue line is the expected central bank rate across developed markets. But that was frankly, this was for Monday and seems to be out of date already by Friday. But there's just a massive gap between the inflation expectations and bond yields. So the white line is US 10-year break-evens. So that is the difference between the yield on inflation-linked bonds and bond yields. The break-evens are expecting inflation of 3.8%, but the 10-year bond is only yielding 1.6%. So if you buy those bonds, you are locking in an expected loss of over 2.2% per annum for 10 years. That's a lot. Okay, moving on. Last week we talked about the UK government's Help to Buy scheme, and regular contributor Stuart Owen asked me to do a bit more digging about the effect of the Help to Buy scheme, and I came across a really interesting paper. So this is from a 2019 paper about the UK's Help to Buy scheme, and it concluded that in London, the Help to Buy scheme inflated house prices while having no effect on construction volumes and no effect on private mortgage lending. Essentially, London house building is heavily constrained by the planning process. So increasing demand has no effect. It just drives up prices. What you need to do is increase supply, which is difficult, and of which, of course, the government hasn't done. So what they did was they looked at house prices at the edge of London. And so they compared houses just inside London, which get the Help to Buy scheme free money, essentially, free loans to house buyers, to those just outside London, which are similar, which don't get it. And what you see, the red line is the prices of houses just inside London, and the blue line is prices of houses just outside London. So the net effect is you have managed to raise the prices of houses inside London by what, about 20%? And the same is true when you look outside London, and you do the same for the English-Welsh border. Now, the Welsh have their own Help to Buy scheme, but it operates on a more limited range of properties. And you'll see the net effect is that house prices outside London have been pushed up by around, 10%? Who's done well out of this? Well, property developers. The blue line is the profits of property developers who don't benefit from their Help to Buy scheme. The red line is those that do, and they've gone through the roof. And the Help to Buy scheme only operates up to a maximum value of 600 grand. So the left-hand chart is a histogram of property prices in England pre-Help to Buy, and these are asking prices. And the right-hand one is post-Help to Buy, and you see there's an enormous spike at 600 grand. So developers have built a load of houses and flats for sale at 600 grand to get the maximum out of the Help to Buy scheme. Okay, moving on to China. Richard, do you want to do this?
Keith, thanks. Okay, it's China's real estate bubble, which, as we know, is in trouble. And we all know about the ghost cities that they have built, and that have been apartments have been purchased by speculators as opposed to people who want to live there. And it's potentially a giant Ponzi scheme. And it is a huge element of the Chinese economy, 30% of the Chinese economy. And it's in serious trouble, as we know from Evergrande and other big property developers that are defaulting or potentially defaulting on their bonds. and the Chinese government is having to scrabble to try and contain it. Developers are shunning land auctions by local governments because they haven't got the money, and also they can't sell them, I suspect, if they build the apartments. So the whole sector is basically going into some sort of grinding to a halt with sand and gearbox. The other interesting thing this is going to do is Chinese steel demand is, I'm not quite sure what percentage of Chinese steel demand is driven by the property sector, but it's a chunk of it because, of course, these blocks of flats, basically the skeleton structure of them is steel. So if you build a 30, 20, 10-story block of flats, you've got a huge steel skeleton around which the infrastructure is built. So there's going to have a significant impact on steel demand, which will have an impact on prices of other commodities, and then copper for wiring and plumbing and so forth. So there is going to be a demand impact on commodity prices, which you would expect to be reflected in pricing over time, but it's difficult to know what it's going to be, and we have other supply constraints. So hard to know how all of that is going to balance out.
I'd also add, Richard, that this is going to have a big impact on Chinese finances, in that that local governments mainly fund themselves through land sales. Right. And this chart shows 27% of land parcels were not bought, and that seems to be getting worse. So, you're seeing an unfolding financial crisis as well in China. We'll see what happens.
That's interesting, because that effectively means that Chinese local authorities are being funded by debt.
Yeah.
As opposed to taxation. It's a little bit like, we have this in the side, we have these local authorities who've been borrowing money from the government at very low interest rates, investing it in property to boost their returns. And now with everybody working from home, the value of the property has dropped significantly, and they're nursing large losses.
I wasn't aware of that. Interesting.
Yeah. They've been borrowing from the Public Works Loan Board at some very low interest rate, buying commercial property, renting it out at 4 or 5% yield, and pocketing the difference to help fund their services. But that's grinding to a halt now because the yields, the valuation of these office buildings is dropping, and the tenants are going away, so they're getting a void rate. So ultimately, the local authority is left holding a large valuation gap, which you can't fund. Sorry, that was an aside.
That's right. So Chinese property developers are heavily indebted, and you remember that the Chinese government has been cracking down on them and has got these 3 red lines. So, and essentially, if you're interested, pause the video and look at this, but most of the big Chinese property developers have breaching at least 1 red line. So they will have to shrink, or they have to sell assets, cut debt to get back under the red lines. And the numbers involved are not small. Evergrande debts of 300 billion.
The other question here, Keith, is we don't know how much debt is in the shadow banking market either. In addition,
yeah, absolutely. And defaults are continuing, and as a result, you're seeing a spike in Chinese junk bond yields, and that, of course, will limit the flow of investment into new businesses and startups. And of course, we don't know how much of this is just due to the property sector, but if this is generally across the whole high yield sector, then you are sucking finance out of the economy, essentially startups. And having come back down a bit, they have started rising again. So this is an ongoing problem. And obviously, the ratings agency have started to downgrade Chinese developers after the horse has bolted, which they did after the great financial crisis as well. And this is this week's Chinese property developer blow up. And this is Yango Group.
The ratings agency's forecasting capacity is quite similar to the central bank's forecasting capacity, isn't it, Keith? Perhaps they should get together, see if they can solve problems collectively.
Well, the thing is, Richard, there's essentially no consequences for getting it wrong. So they just say what they want to say. Everything's fine until it ain't, and they say, "Oh, it's changed."
And I believe that's how they get paid, isn't it? They get paid by giving a decent rating.
Okay, so on to other charts. So we talked previously about how central bank largesse and the US government largesse had massively increased US savings rate. People had money in their accounts. Well, they've spent it all. This chart shows that the markets have not had to absorb many government bonds because the Fed has bought a load and commercial banks have basically bought the rest because they don't want to lend to anyone else. So if the blue line is the number of US Treasury bonds in issuance, which is shot up, and the red line is the number of bonds that have had to be sold through the market, i.e. the ones that the Fed and commercial banks haven't bought directly. And the reality is it's barely above the pre-pandemic levels. But we know that there's going to be a load of supply coming onto the market soon, and who's going to step in and buy them? Because as we've covered in previous weeklies, we know that foreigners have largely stepped back and are not buying US federal bonds.
Well, the Fed will either have to force financial institutions to buy them by changing the rules, or they'll have to stop tapering, or the government will have to stop borrowing. And none of those are palatable. But one of them has to be the solution.
So this is the US federal deficit. You see, previously it was steadily deteriorating anyway. It's getting worse year on year. And then suddenly you have COVID and this looks really bad. You're now borrowing, what's that, 3 trillion a year, best part of.
I mean, effectively, what we're really getting, just going back to inflation, is the inflation that has been in the financial markets for many years as a result of QE is moving into the real economy. So earnings in quarter three, the weakest they've been in the recovery. So we've been commenting how earnings expectations have always been increasing, and analyst earnings expectations have been increasing, which has been driving the stock market. What we see here is that in the right-hand graph, analyst expectations have leveled off. So we're not looking for earnings to continue to increase, which has been one of the main drivers of the stock market's appreciation. And if these analyst expectations are right, then that driver will disappear, which is interesting. And there are a couple of factors that will affect this. One is the clearly margin compression due to inflationary increases in cost in input prices. And the other thing that increases earnings is share buybacks. Now, I'm not quite sure what's happening with share buybacks across the board at the moment.
They're going absolutely through the roof, Richard.
And maybe that's in an effort to counter this otherwise plateauing and possibly even falling of earnings expectations.
So corporate earnings are back on trend after essentially the shortest earnings recession in history. Now, I thought this was a really interesting chart, actually. So this is from John Kemp at Reuters. And this shows US manufacturing output over the last 30 years. And you'll see there is a big structural break at the financial crisis. And since then, really, US manufacturing output has been going absolutely nowhere. If anything, been slightly declining.
So on COVID, we've just got one slide for you this week. Mainland China braces for the broadest outbreak since Wuhan. So basically, China has a COVID problem. And I don't know actually what has happened with the Chinese vaccination program. Neither do I know what the real effectiveness of the Chinese vaccine is, because they never published the data as far as I'm aware. And clearly, with this level of symptomatic cases over such a broad sweep of the country. They pretend, and the R number of the delta is much higher than the original R number was, or the infectivity of the delta is much higher than the original virus. It looks like they could be heading for serious problems, which would cause them to have to go into another lockdown with all consequent damage to their economy and damage to the supply chains.
Yeah.
Even if the rest of the world can stay open.
Well, they're very draconian, generally, the Chinese. So if they get one case, they'll close down the entire port, whatever. And, not caring about the knock-on effect. But
what this chart doesn't show us is the actual population numbers.
Yeah.
And Rebuse will know what the hospitalization and death rates are.
But the other thing, Richard, is that this chart is just silly. I mean, these may be the numbers they're reporting, but one case, honestly, the when you're talking about the vaccination policy in China, I very strongly suspect it is you will all be vaccinated or else. There's no kind of vaccine hesitancy. If you're hesitant, you get sent to the gulag. So I don't think anyone's that hesitant. But also, if they are going to close down the entire city, if there's a case, then I strongly suspect that if you got a cold, you're kind of staying indoors for a bit, hoping it goes away, because you don't.
Yeah, because you don't want to be locked. You don't want to be shut down, do you? Just keep your fingers crossed and hope for the best.
Yeah. Okay, so on to the checklist. And God, this equity markets of the world are absolutely mind-blowing. Another strong week. So all share up 0.6, stocks Europe up 1.7, now up 21% on the year. S&P 500 up 1.8%, up 25% on the year. NASDAQ up 3.2%. Topics, Japan up 2.2%. Bitcoin up 2.1% to 115% on the year. USG sterling, the banana currency of the UK, had a bad week, down 2% as we failed to raise interest rates. And
banana currency, Keith, that's very rude.
I've seen the long-term chart. Sterling, the reason it's called sterling was it used to be a pound of sterling silver, like a bar weighing 1 pound of silver. These days, you struggle to buy a Kit Kat with that. So anyway.
Especially in a motorway service station.
Yeah. So in answer to Richard's...
bring back the gold standard, Keith. Clearly, that's the answer.
Yeah. So in answer to Richard's question, what's happening about buybacks? Well, this is buybacks. They're going through the roof. But the dividend yield, real dividend yield of the S&P 500 is at an all-time low because...
the buy and hold strategy, if there's no price appreciation, the buy and hold strategy is lose 4% a year in real terms.
Well, that's the earnings you'll get. As long as you get compensating price appreciation, which frankly you are, then it works. But, buying it for income, currently the S&P, not a good idea. But meanwhile, in cyberspace, Tesla share price has absolutely gone through the roof. And this is the share price of Tesla compared to the share price of Berkshire Hathaway, which is actually the most profitable company in the US, Warren Buffett's company.
I was listening to someone the other day opining on Tesla's market cap and what would happen when it comes back down to reality. And he says it could cause a systemic crisis because it is so large. And there'd be such a large volume of losses throughout the market that the effect would be very difficult to predict and could be quite dangerous. If it dropped to, 50 billion, which is probably what it's really worth, you've got a 1.15 trillion write-off in the market.
Yeah. Well, it won't cause me any losses at all, Richard. So these are the most profitable companies in the US. Number one, Berkshire Hathaway. Number two, Apple. Whereas Tesla, to be fair to Tesla, does actually make some decent money these days on an EBITDA basis, which obviously, because it manufactures cars and, physical stuff, it won't have any depreciation and amortization according to the market because it don't have to invest in things like factories. Yeah. I roll my eyes. Anyway.
The chart of Easter, which recently hit a new all-time high, there's a nice upward trend on the right-hand side of the chart. And the next chart is the log chart, which goes from February, March 2020, so that 18 months. And you can see it's following that logarithmic trend quite closely, actually. And clearly, some people are projected. Well, I read somewhere the other day that only about 10% of the total available Ether is actually in the marketplace to be bought and sold, and the rest of it is sitting in strongly held, which means that it is actually very susceptible to a short squeeze. On the other hand, it also probably means it's susceptible to a significant price drop. So it's volatile in both directions, I guess. And the next chart is Bitcoin, which isn't, it's performing reasonably strongly, but it hasn't really gone anywhere for a few weeks, and it hasn't really broken above its all-time high in the way that Ether has, because it's dropped back below it. So we'll see. I'm holding my positions. And the last chart that we put in is Squid Game. So Squid Game, as you probably know, is a Netflix series that has gone viral, and I've just started watching it actually, because I wondered what it was. Keith tells me he's watched it already. But these people produced a Squid Game token, which rocketed from 36 to, okay, so it went up 100-fold, didn't it, give or take? And then this is what's known as a rug pull, apparently, in the crypto market, in the crypto world. They're basically, having sold these coins, made a complete, absolute fortune. They then disappear with the money, with the dollars, and that's a rug pull. And it was obviously highly successful. I don't know what the Squid Game coin was supposed to offer the subscribers, but in reality, it offered them a loss of all their money.
I think it was a token you had to use in a spin-off game, basically. But essentially, the people who developed the coin had no relationship whatsoever to the filmmakers, and it was all a big scam. But
nice work if you can get it, though. I mean, how much did they make out of it?
Well, if you look at the turnover, it was millions. And scratch one for the cynics, though.
Well, that's Keith. I mean, absolutely, I'd agree with you. It's fortunately, I managed to sell mine near the top. I jest.
Okay, now moving on to commodity markets. Now we have this week split the commodity markets into two sections: energy and the rest, because it was getting a bit crowded. Okay, so it was generally a poor week, and coal had a total shocker. So oil was down 3.2% to $80, which is still very high. Natural gas is drifting off, but we're getting into winter, and in Europe stocks are low. So Dutch natural gas futures were down 5%, but they're still very elevated levels. Coal, amazing week, down 30%. We'll go into that. Uranium down 8.3%. So generally, energy commodities have had an amazing run this year, but a bad week. Okay, so this is price of crude oil, bad week, but still, very strong and far above levels expected at the start of the year. Now, in China, these are flights, internal flights, and you'll see they're coming off again. So one of the big drivers in energy demand is flying. Obviously, flying was very depressed in the COVID pandemic, and it's been coming back, but that seems to have stalled. And is this a danger sign that if China locks down and other people lock it down again, as we come into the winter flu and COVID season, then you could see oil demand come off again. Now, last week we talked about how China has one enormous energy hedge fund, having bought loads of crude oil when it was cheap, and is now running down its stocks. But Chinese crude demand has remained high. The red line is imports, and the blue line is inventories. So they have been both reducing their imports as they've run down inventories, and that is unsustainable. At some stage, they're going to have to start increasing their imports again. And you'll see that over the course of the last month, they've reduced their imports by the best part of 2 million barrels a day. So when they've stopped running down inventories, they're going to have to substantially increase imports. And that is very bullish for oil, medium term. And globally, inventories continue to fall. And last week alone, Carrios, who use satellite data, etc., to measure global inventories, saying that crude stocks fell by 4 million barrels, mainly driven by India. But this is the oil seasonality chart, and traditionally the oil price takes a bit of a bath in October and November, and we are now in the worst month. So it could be a bad month for the oil price. Okay, moving on to natural gas. And natural gas obviously had an enormous spike up, and, you know, we are now coming into winter season. It's getting cold. Inventories are low. Don't know where the European natural gas price is going to go, but it is very elevated already. And Gazprom have stated they are going to start raising their gas exports to Europe, but their storage levels are really low. So this is the amount of gas stored in Germany by various entities, and you'll see Gazprom have run their storage levels right down. And having said that they were going to start filling them from the 1st of November, which is what we described last week. Last week, their exports to Europe actually fell. And now they're talking about raising exports to Europe from the 8th. Okay, moving on to coal. And coal had an absolutely extraordinary week. It's down 30% on the week. And that is because the Chinese have cut demand by rationing power. And they've also told all their coal mines to work super hard. And they have managed to raise coal production to 11.6 million tons a day. 11.6 million tons a day. And that's up 1.2 million tons month on month. As a result, Chinese power stations have managed to restock. So they now have 13 days of coal on average in stock, up from just 2 in mid-October. So it looks like the Chinese power crisis is easing.
But what that equates to, Keith, very roughly off the top of my head, is about 70 million tons of carbon dioxide production per day.
Yeah.
If that's what they're burning.
Yeah.
And of course, they've refused to take part in the COP summit, haven't they? They're not engaging with this. This is a side to side. It's not affecting the commodity price, but it's a total. It's a complete in complete contrast with what most of the rest of the world is trying to do. But,
yeah. Well, you know, we saw last week the chart showing the world's largest carbon dioxide emitters, and China is massively bigger than anyone else. And, you know, this is a very depressing statistic, frankly.
It's interesting that they can boost coal production that much, and it makes you wonder whether that is a one-off boost that will tail back down, or whether they can maintain production at that level. I don't know.
Well, I hope they can't.
So uranium has sort of seemed to settle down around about the mid-40s, and it's up about 40% as we showed on the year. It is undoubtedly going to be one of the fuels that provides the link between where we are now with fossil fuels and moving to renewables. And so my view is that there's a strong bull case for uranium. But what part of the strong bull case does require that nuclear power stations either are reopened, in the case of Japan and even Germany, or built and fuel is taken off the market. And that is a requirement for the price to continue to rise, I believe.
Yeah.
So I think it's probably a longer term bull market, 4 or 5 years. I don't think I had a big spike with the Sprott ETF, but I don't think it's going to spike up to a high price right now, because I don't think there is the buying power for that.
Yeah.
And we need to build more nuclear power stations. Exactly. So the energy return on energy investment, which is a very interesting chart actually. So the energy return on energy investment for solar power is very low. So you have to put a huge amount of energy in to get your energy back. And wind is extraordinarily low.
Yeah.
Basically, the ones that work are coal and gas. Presumably oil would be in there. Hydro, because once you've built the dam, it just works forever. And nuclear power, which you have to put relatively little energy in to get a lot of energy back out. It's a really interesting graph.
Yeah, no, we need to build a load of nuclear power stations, factly. Yeah. So, currently, to build your solar plant, you have to, it takes a lot of materials, all of which are really energy intensive. Yeah.
I mean, I actually quite envy France with its 80% of its electricity production via nuclear power. They are sitting pretty. Probably the most comfortable country in the developed world in terms of its energy supply.
Okay, on to industrial commodities, and we'll push through this quite quickly. So aluminium had another poor week, down 2.9%. Cobalt and renewable exposed commodities are doing very well. So cobalt up 3.5%, up 80% on the year. Copper down a touch. Chromium continues its mystifying run, up plus 0.7%. Iron ore collapsing, down 17% from already low levels to a new low. Lithium up further 1.6%, up 320% on the year. Magnesium, we'll show you the chart, is collapsing. It had an extraordinary run and down 27% on the week. And so we've added magnesium this week because in order to understand aluminium, you also have to understand magnesium, which is a key component of making aluminium alloys. Neodymium, great week, up 9.8%, up 192% on the year. Nickel down slightly, down 3%, up only 16% on the year. Tin continues its relentless grind higher, up 1.9%, 80% on the year. Ferrovanadium drifted off 0.9%. This is aluminium coming right off. As the power problems in China ease, I expect the aluminium supply to start normalizing, and that's what this chart is showing. Cobalt grinds higher. Copper in its range. This is electric car sales in California, and you'll see that they peaked in 2018 up until this year. In the first half of this year, they sold 121,000 cars. So your annualized is going to be a massive increase in car sales in California. And that's bullish for all these renewable metals and copper. Chromium, iron ore collapsing. Lithium grinding higher. Magnesium. Now, the reason magnesium spiked so strongly is because magnesium is incredibly energy intensive. To produce a ton of magnesium, you require almost twice as much electricity, in fact, over twice as much electricity as you do to produce a ton of aluminium. And so the Chinese had mandated huge cuts in magnesium production, but those are now easing, and the magnesium plants are now back to between 60 and 70% of capacity, up from 50. And so the magnesium problem is easing, but you'll see that prices are still up 50% from July. Neodymium spiking, nice looking chart now. Nickel in its recent range, tin just grinding higher. Ferrovanadium, like iron, has come off this very recently, and its little rally has failed. Richard, precious metals?
Yeah, so this week was a modest week for the precious metals, really. Gold and silver virtually unchanged. Platinum up 2%, rhodium unchanged, palladium up 2%. And I think one of the interesting things for me about the price of gold is that it really doesn't seem to want to drop below about 1750, and it's pretty much stuck between 1750 and 1830. And if it breaks out of that range in either direction, it potentially has a significant move after that. And silver is doing something quite similar. It too is in a range. And again, if it breaks out, I think it's about 28. If you look at a longer term chart of silver, you see that range. If it breaks up above about 28 or down below 22, you might expect a significant move. But they're really just trapped in those ranges at the moment, despite the high inflation numbers that we're getting through at the moment.
Yeah. Precious metal being a very poor inflation hedge, sadly.
Yeah, so far, yeah. Platinum, as we know, platinum is very dependent on the auto sales market, catalytic converters, and also used in production of hydrogen from electrolysis of water. So it's just seems to have steadied slightly at around about $1,000, just above $1,000 an ounce. And rhodium, has followed that huge spike up, spike down, and now seems to be steady at about 14,000. And palladium, very similar, not really doing very much at the moment.
Yeah. So demand for palladium at all the PGMs, of course, is depressed by the fact that all the car manufacturers have closed down or closed their production, cut their production by up to 50% on the chip shortage and supply chain problems. Of course, all the time that they're not working at full capacity, the PGM miners are. So you're building up this inventories of PGMs, which will then have to be worked through.
I think that's a good point, Keith. Very good point.
Finally, on to rates. And as we have talked about earlier, the Bank of England failed to raise base rates. And as a result, the UK yield curve, you had falls in yields from 20 years and lower. Only the 30-year rose, and that rose by less than 1 basis point. So the market really is buying the narrative that inflation is going to be transitory. So you can, if you invest in UK 30-year bonds, you get a yield of 1.1%. And bear in mind that inflation in the UK is above 4%. And the Bank of England are saying that they expect it to reach 5%. Now, in looking at the periphery, what's interesting is that Greek yields are continuing to rise. So the Greek yield is now, these are not at worrying levels, but the trend is. So something to watch as the ECB starts to think about tapering and the end of the pandemic emergency purchase program. And on that note, the red bars are euro area bond supply, and the grey bars are ECB purchases. And you see in the last couple of years, the ECB have bought more bonds than they're actually issued. And then next year, that will start to change. Hold on to your hats.
Yeah.
So this is the UK 2-year, when they didn't raise rates, it came right back down. Now, if the UK, if the Bank of England loses the trust of the bond market, you'd expect the opposite to happen, but it retains the trust of the market currently. But real yields in the US are heading right back down as essentially bonds. Interest rates don't rise, but inflation does. And it's shaping up to be a corking bad year for bonds because inflation's rising and bond yields have risen, although nowhere near as much as I was expecting. And, nobody wants to buy them apart from the Fed. So
they don't want to buy them, they just have no choice.
Yeah. Where allocations are very low. So who's going to buy them when Treasury issuance starts rising again? But the Treasury market is suffering from, bond market in general is suffering from low liquidity. So this is the blue line is US Treasuries and the white line is German futures. And it is the size of the bids and asks. And you'll see that market makers are offering to buy and sell much smaller quantities of bonds. So the depth of the market has really shrunk. This is UK 10-year gilt, which came off. The yield fell when the Bank of England didn't raise rates. And that actually bond markets around the world followed the Bank of England. And finally, the seasonality chart. And the seasonality chart continues to be a good forecaster because we've had an astonishing week. Markets have just generally been strong. And frankly, we're now running into year end. Okay, Richard, what did you get up to this week?
Thank you, Keith. So I had yet another quiet week. No purchases, no sales. I was down 0.5%. It was a fairly boring week, I have to say. My crypto did relatively well, but commodity shares didn't do well. My gold and silver mining shares didn't do particularly well. So all in all, quite a quiet week. And I have to say, I was sitting here thinking, wish I put all of my money into a NASDAQ ETF on the 1st of January. It would have been much easier. And who would have thought it, eh?
Yeah.
So what I wanted to do, I just thought this was an interesting chart. I've got my eye on this. This is a cannabis ETF, and it goes back to October last year. It's a year old. It started life at about 2,000. It peaked up to 5,500, and it's back down to 2,500. And it's following a very nice downward trend. And my point here is that if the downtrend is broken in an upwards direction, that might be quite a good time to buy it. So it is on my watch list. Certainly not buying it now. It's on my watch list to see whether it might be an opportune time sometime in the future to dip a toe in the water. I'd much rather buy an ETF in this than an individual company because I don't know anything about the companies. But if you think the sector is ripe for some improvement, then maybe an ETF is the way to go about it. And that, Keith, is me done for today.
Yeah. I would say, Richard, on the cannabis front, it's called weed for a reason. It grows like a weed, and you can just get a seed and stick it in your conservatory, and there you go. You got, a lifetime supply. So I'm deeply skeptical about,
I know that's what you do, Keith. So how was your week, Keith?
Well, it was predictably shit, mate. So energy markets were bad. I was down 1.5% on the week, up 9.3% year to date. And having briefly had a moment of glory when I was beating the all share by 3%, I'm now underperforming it by 4%. There you go. And on your point, Richard, about investing in the Nasdaq, I mean, one of the reasons that my portfolio is underperforming is essentially it's entirely value stocks, and I feel incredibly uncomfortable about owning anything growth related at the astonishing valuations they have. But as we saw from the Tesla chart, they only get more expensive, and my shares continue to get a bit cheaper. But at some stage, that will reverse. So I did a couple of sales this week. So we'll show you the chart in a minute of Trident Royalties, whose share price suddenly shot up midday on, I think, Wednesday, as it turned out it'd been tipped by the Investors Chronicle. And
I know, you use that as a counter indicator.
well, exactly. But also, whenever something spikes up like that, just, if you can, take advantage of it, because it will drift off over the next couple of weeks, and your chances are you'll get back in at the price before. I mean, that's exactly what I've done. So I sold my Trident Royalties. I sold the whole lot in my SIP at 41.5, and it had risen from 36p on the day. And I put in a bid to buy it back plus 15% at 36p. Let's see if that works. I also trimmed my holding in Royal Dutch Shell because I wanted to buy some Cairn Energy. Now, Cairn Energy. So Cairn Energy is an oil company, and years ago it was a subject of the Indian government's tax terrorism department, who confiscated Cairn India, and Cairn Energy have been fighting them for years and have recently signed an agreement with India which should see them recover $1.06 billion. Now, they were claiming, well, a lot more than that. They were claiming up to 1.6, including interest, but they're going to settle for 1 billion. Now, when this was announced midweek, the share price rose initially 2.2% and then closed down on the day. Essentially, the market still doesn't believe that the Indians will pay up. But if we go through the numbers for Cairn Energy, they have a market cap of 1.1 billion US dollars. They've got cash on the balance sheet of 340 million. They've just sold their North Sea assets for 450 million. And that price was based on 1st of January, and it contains various clauses that will see Cairn participate in any oil price appreciation, which there has been. So you expect that number to be the actual amount they'll raise from the sale of Catcher and Kraken to be substantially higher than that. Plus, they should be getting $1 billion from their dispute with India. All of that adds up to 1.9 billion. Plus, they had operating cash flow in the first half of 100 million. So I think the share price should be substantially higher. And I bought some. Oh, I should say I bought more, because obviously I don't have enough oil companies. So now this is our problem child, Rambler. And they said they were going to produce their annual results by the end of October. And, as of the close last Friday, we'd had nothing. And then at 8 o'clock, they came out with the results and announced that they had finally closed the financing round. Marvelous. So Monday morning, it shot up by up to 40%. Went above 30p, and then it's drifted off. But, now when you dig into the Ming mine, the more you look at it, the bigger the resource, and it looks great. The question is, can they mine it economically? And if you believe the business plan and you believe that the ore sorter will substantially increase grades, etc., then frankly, I think it looks good. And obviously, I'm down on my investment, but none of the economics have fundamentally changed. And if they can execute the expansion plan, etc., well, the mine recovery plan, really, with the financing that they now have, then these are the first steps on the road to recovery. So I bought some, last month, down at the towards the lows, but it looks good. Okay, so now another company we covered earlier in the year, and this is another innovative way to fail, because we covered the stock it looked good. They are mining for fluorspar in, was it Utah? Canadian listed company, British CEO. They decided to delist from the Toronto Venture Exchange. And then there was this period where essentially the shares could only be traded on the pink sheets in the US, as they kind of were going to move to a different Canadian exchange. And then they announced that they were going to list on the Canadian Stock Exchange. Now, I hold my shares through a broker who will essentially only allow me to sell my shares via the Canadian Stock Exchange, not buy any. And I suspect quite a lot of shareholders are in the same boat. So the shares have largely collapsed. I still think it looks great. I'd like to buy more, but I can't because they've moved to some exchange where there are no market makers. It works on an auction basis, and essentially in order to buy some, you have to find a seller. So I've written to the CEO and pointed this out. And apparently I'm the first shareholder to have mentioned this to him. So we will see what happens. But, you know.
Well done, Keith, for communicating.
Yeah. This is diversified energy. And this spike last week downwards, which we covered, was when, you know, the Bloomberg had come out with a piece on how the big methane leaks, and then the share price was around £1.30. Share price recovered a bit. And of course, this week it's been COP26, Biden administration talking about curbing methane leaks, which, you know, DEC have more than enough resources to actually get their act together and fix the methane leaks, but obviously bad PR, share price down. But it yields what, 11%?
Yeah.
Now, Goldplat had their results this week, and I thought they looked great, actually. When we first did our share talk on them, they had Kilimapesa mine, which is losing the money, and Ghana operations, which were unreliable, trying to get enough feedstock into the Ghana operations. Well, the Ghana operations now are doing well. They've sold Kilimapesa and they've got shares in return. And actually, they're now talking about setting up operations in South America. And they are getting feedstock from South America. So, you know, concentrating on gold recovery, all looks good. Obviously, the gold price hasn't been great, but I have a bid in to buy more at 7p. And finally, this is Trident Royalties. Lardy darn, nout happening. The Investors Chronicle tips them. And, you know, what's that? 20% rise. And I didn't get the top, but I got somewhere around here. And I expect this chart to just slowly drift down back to 36p when I buy it back. That's the plan.
Fingers crossed.
Right. So that's it for this week. Thank you very much for watching. I hope you'll press like and subscribe and think about donating. And in the meantime, it is goodbye from Richard Weiser.
And it's goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.